In this video, our focus is on working through an example of cash flow while incorporating depreciation methods into the overall product evaluation. Let's look at an example. The Wizard Weed Whacker Company, WWWC, is investigating the feasibility of a new line of weed whackers aimed at the growing number of home gardeners. Based on exploratory conversations with buyers for large garden shops, WWWC projects unit sales as follows. In addition, the new weed whackers will sell for $240 per unit to start. After 3 years, WWWC anticipates that the price will drop to $220. The project will require $40,000 in net working capital, that is, at the start of the project. NWC will equal 15% of sales at the end of each year. Variable cost per unit will equal $120. Total fixed costs will equal $50,000 per year. It will cost $1.6 million to buy equipment to begin. The equipment will qualify as 7 years maker's property. The equipment will be worth 20% of its cost in 8 years, or 0.20 times 1.6 million equals $320,000. The relevant tax rate is 34%, and the required return is 15%. The big question is, should WWWC proceed? First, let's calculate the expected revenues of the project. We calculate the revenues by multiplying the unit price by the expected unit sales per year. We also need to calculate the depreciation based upon the total equipment value needed for the project. Remember, the equipment cost was $1.6 million, and the equipment has a 7-year life. Remember that this means that the depreciation will actually occur over 8 years using makers. Now, let's put the revenues we calculated, the variable cost per unit that were equal to $120 per unit, the fixed costs that were equal to $50,000 per year, and the depreciation that we calculated together for each year. Once we have the EBIT, we can calculate the taxes and the net income. For this project, we did not have any interest expense to calculate. Net working capital requirements change as sales change. In each year, WWWC will generally either add to or recover some of its project net working capital. NWC starts out at $40,000, then rises to 15% of sales. We now project NWC. The change in NWC for year 8 is $66,000. The project has a peak net working capital of $432,000 in year 3. Also notice that at the end of the project's life, there is $198,000 still to be recovered. This means that in the last year, the project returns $66,000 of NWC during the year, and then returns the remaining $198,000 at the end of the year for a total of $264,000. Finally, we account for the long-term capital invested in the project. The company invested $1.6 million at year 0. The equipment will be worth an assumed $320,000 at the end of the project with a book value of 0 at that time. Assume that we sell the equipment at the end of the project. The $320,000 excess of market value over book value is taxable. To calculate the tax proceeds, they will be $320,000 times 1 minus 0.34 equals $211,200. Now we can calculate the operating cash flows, the change in net working capital, as well as the capital spending for the equipment. Using the operating cash flows, the change in net working capital, and the capital spending for the equipment, we can calculate the cumulative cash flows. We would discount the cumulative cash flows back to time 0 for each time period. After the cash flows have been discounted, we sum these amounts. The sum is the net present value. The positive net present value represents the additional value the project will return to the company. We can also use the cash flows to calculate the internal rate of return and the payback period. Now that we've completed the preliminary discounted cash flow analysis, now what? If we have confidence in our projections, WWWC should begin production and marketing right away. This is unlikely. It is important to remember that the result of our analysis is an estimate of NPV, and we will usually have less than complete confidence in our projections. We will almost surely want to spend time evaluating the quality of our estimates.